Good morning, everyone, and thank you for joining us for day one of Cherry Bekaert's 2021 Industrial Manufacturing Virtual Conference. My name is Matt Brady, and I'm a tax partner here at Cherry Bekaert and also lead Cherry Bekaert's Industrial Manufacturing Industry Group. Today, we are kicking off our 2021 virtual conference, which will feature 4 sessions over 2 days, covering a variety of hot topics, recent developments, and proposed updates tailored to the industrial industry. Day 2 of our conference will be hosted next Wednesday and feature our 3rd and 4th sessions focused on tax legislative updates and tax-efficient supply chain planning. We're excited about the lineup. We have planned for this conference, and we will be offering up to 1 hour of CPE per session, all important CPE here in December. We hope you're able to join us for all 4. Now, before we get too far, let me touch on a few housekeeping matters. To receive CPE credits, you must answer at least 3 of the polling questions and attend the full 50 minutes of each session. We have 2 50-minute sessions today, so you will see a minimum of 6 polling questions. A short summary will be posted at the conclusion of today's conference. We would appreciate any feedback you're willing to provide as we use that information to formulate future content pieces and seminars, and to ensure that we're consistently evaluating the best way to share information with our current clients and prospective clients. CPE certificates will be issued via email within 10 days. If after 10 days it has not been received, please email cbhlearning@cbh.com. Also, a recorded version of this webinar will be available in approximately 7 days. It will be sent via email and posted to our website. If you have any questions during the webinar, please type into the Q&A window located in your control panel. Now that those housekeeping items are out of the way, I'd like to introduce our first speaker. Chad Mutray is the Chief Economist for the National Association of Manufacturers, NAM, and we'll be presenting on our first session entitled The U.S. and Global Economic Manufacturing Outlook for 2022. Chad serves as NAM's economic forecaster and spokesperson on economic issues and frequently comments on current economic conditions for manufacturers through professional presentations, media interviews, which have included various news outlets, including CNBC. In addition, he is the director of the Center for Manufacturing Research at the Manufacturing Institute, which is the social impact arm of NAM. In that role, he leads efforts to produce thought leadership, analysis, and data of relevance to business leaders in the sector. Prior to joining NAM, Chad was the Chief Economist and Director of Economic Research for the Office of Advocacy at the U.S. Small Business Administration from 2002 to 2010. In that role, he was responsible for researching the importance of entrepreneurship to the U.S. economy and highlighting various issues of importance to small business owners, policymakers, and academics. Prior to working at SBA, he was the Dean of the School of Business Administration at Robert Morris College in Chicago. Clearly, from that intro, Chad is an expert in his field, and we are thrilled to have him here today with us. Look forward to getting your input, Chad, on the short-term outlook for the industrial sector. It's all yours. Take it away.
Well, thank you, Matt. Thank you. And hopefully everyone is having a great day. You probably saw me look down at my phone early on because we got new job openings data a second ago. So job openings all-time high, 1 million job openings in manufacturing, 11 million in the overall economy. We can talk about that a little bit later. And you can see on my title screen here is my Twitter. I'll be tweeting about job openings later this morning, hopefully. So I'm going to go straight into, hopefully everyone is ready. We're going to go straight into a polling question. Here's the question. And the reason why we're starting with this one is my first slide is about the NAM Manufacturers Outlook Survey. And we've been doing that survey since 1997. And I literally, right before this session began, hit send on the draft of the 4th quarter survey. So as we're talking about what you're seeing in the economy, I can actually maybe hint about what our members are saying as well. A little background on the National Association of Manufacturers. We have 14,000 members. Every state in the country, and DC, every firm size, companies you've heard of, some of them that you haven't heard of, and we have been around since 1895, so we're the oldest trade association dedicated to manufacturing. We also have every state has a manufacturing association that's affiliated with us, as well as we have 250 vertical associations. And so with that, we can see here that 44% of you are positive, very positive. 44% of you are very somewhat positive. So that means that basically 88% of you are either somewhat or very positive, and that's actually pretty consistent with what we see in the larger survey as well. So here, let's go. Now that we've done that, let's go in to show you what the survey says in general. So this is through the third quarter. So you can see that in general, since we've been doing the survey, roughly 3/4 of our members are positive at any given time over the last, 25 years, 24, 25 years. And you can see here the recessions that are highlighted. The most recent recession was from February to May of last year. That was the shortest recession on record. And just to go to the next slide, just to show you what it looked like in September. I can't give you the December number yet, but you can see that we've bounced back pretty strongly since falling to 33.9% in June of 2020. That was the lowest since the Great Recession. And the 90% figure that we had in June of 2021 was the best in 3 years, right? So we've pulled back a little bit since then, both in the September survey and likely in the fourth quarter survey. And a lot of that really has to do with the supply chain challenges, rising costs, right, which our members continue to complain about, workforce issues, COVID-19 continues to be out there. Obviously, everyone in the September survey was talking about Delta. Now it's obviously Omicron is kind of the uncertainty that's out there. Yet, even despite all of those challenges, the fact that we have 88% in your survey, roughly the same in September in this survey, suggests that manufacturers in general are still pretty upbeat, right? And I think that's if you're looking for some positivity here, that definitely is it. When you're looking at expected growth rates, like a lot of these surveys, we say, what are your expected growth rates in a number of categories? And you can see overall, even though the numbers have pulled back a little bit from June, you're still seeing pretty solid readings for sales. Production's not up here, but production would be the same. And in the September survey, you actually had capital spending at a 3-year high and full-time employment at a record high. And so, to me, that's a nice sign that manufacturers are continuing to invest in themselves, whether that's human capital or physical capital. And that is obviously a nice positive thing to come out of this. Again, even though we've seen some easing since the summer, largely again on those supply chain issues. So that brings us into, before I go into what the survey says are the questions, the top challenges, another poll. We're going to do 2 back-to-back here pretty quickly. So what are the top challenges? I've more or less hinted, I think, what our members are saying along some of these lines, but many of you probably are seeing similar frustrations when you're looking out at what you're seeing. So we have about another 30 seconds, I think, here to go. It's interesting to look at the numbers that are coming in. No one is saying the dollar, which is interesting, which is not inconsistent with what I'm seeing, but interesting. Okay, there's our minute. So it looks like the number one issue here is by far rising raw material costs, but you also have some pretty decent readings up here for trade uncertainties, unfavorable business climate, and weaker economic growth. So that's pretty consistent again with what we have in our survey. So there it is. So this is the third quarter survey. You can see increased raw material costs, much like what you guys said. was the number one issue. It actually has been the number one issue all year long. It is still the number one issue in the fourth quarter. I can say that. And when you look at the top four, at least in my view, they're all somewhat interrelated, right? So attracting and retaining a quality workforce, that certainly speaks to the tightness of the labor market, and almost everyone that I speak to says not only are they having trouble finding talent, especially entry-level workers, but they've had to raise their wages pretty substantially. A little aside, there's a very interesting story, I think, in the Wall Street Journal today about the effect of Amazon and the impact that that's having, all of their logistical locations on wages around the country. So just kind of refer that to you at your leisure. But you can also see supply chain challenges and transportation issues. So this really speaks to the issues with the ports, right, and with cargo sitting offshore. It speaks to the lack of truck drivers, right, that we continue to hear about in terms of logistical challenges. And it speaks to some shortages in some commodities, right? We've heard a lot of shortages in the metal side and natural gas and other commodities, and all of that has pushed up overall prices, and we continue to hear that pretty widely. With that said, in the third quarter, if you go back to when I was writing this survey, it was basically August, and everyone was talking about Delta, right, and the Delta variant and what are the downside risks that were there. And I was looking out and saying, well, our numbers are still pretty upbeat. What are the biggest downside risks? And I was expecting some of these other factors to be at the top. And yet what you see here is the number one downside risk, at least according to our members in September, was workforce shortages. The fact that we didn't have enough workers to be able to meet demand. There were clearly capacity issues. Obviously, the truck driver shortages impacted this as well. It was right up there. Still, you have supply chain disruptions and cost pressures towards the top of the list. And Delta, roughly half of our members said that. But in general, I think workforce, and this speaks, I think, to, again, some of the challenges that we're having. The job openings data that came out this morning, for instance, that are really impacting wages and our ability to meet capacity. So turning away from the NAM Outlook survey to the ISM survey, so we get this one, we just got it on December 1st. So this shows you really what's happening in terms of manufacturing activity nationally. Just a reminder, numbers over 50 are expansion, right? So we're over 50 in when you're looking at the PMI, the Purchasing Managers Index, and new orders and production throughout all of this time period. And in fact, you see numbers over 60 for much of this time period for both demand and output, right? So that, again, speaks to why manufacturers tend to be very upbeat in general. Some comments up here. Notice that the red line starts pulling back, still solid reading, but starts pulling back in March, and that largely speaks to the supply chain challenges, right? That the most manufacturers are experiencing, and while there's still a relatively healthy reading overall, and you did see that number bounce back a little bit in November, it still reflects some challenges that manufacturers are facing. You see a similar pullback starting in October on the demand side, as the inability to really be able to produce what we need to produce has impacted the ability to place orders. You'll hear me talk a lot in the next couple of slides about autos and the impact that the chip shortage, for instance, has had on the inventories of autos. And that really, at least to me, plays itself out pretty strongly in the October data writ large, not just in the ISM data points. The other color up here to highlight is the yellow one, and that is the employment reading, which, as I just noted, that we have a very tight labor market. Employment in general has been a bright spot in the manufacturing sector this year. And yet this number has hovered around 50 for much of the last few months, did kind of pull back a little bit and has given a pretty decent reading in October and November. But you saw some weakness there in the middle part of the year. And that had a lot to do with the challenges of hiring for the most part. It wasn't that manufacturers didn't want to hire, it's just that they had trouble doing so. So let's talk about manufacturing production. So those are all sentiment surveys. Let's turn to some hard data. And you can see here lots of choppiness in the overall output data so far this year. And I'm only giving you April on, largely because if I had too much data up on here, it would be too hard to read. but also you had a lot of volatility in the first quarter of the year, largely related to weather, and specifically weather in Texas. And so you saw a huge decline in February related to the storms that we had down there, and the energy, there's no energy for a week or so. And then the nice bounce back. So that's what you're not seeing on here, but again, it just adds to the volatility that we see. And while we had a pretty decent reading in the October figures up here for manufacturing production, you can see again, once again, the middle of the year, that June to September timeframe was more weakness than not, right? And a large part of this conversation, whether we're positive or negative, has to do with swings that we're seeing in the auto sector. So just to kind of put some numbers on that, and you'll see autos a little bit more when I kind of dive in to the October data, but we had a 7.2% decline in manufacturing production in motor vehicles in the month of September alone, right? So we traditionally sell around 17 million vehicles. That's where we should be in terms of autos on an annualized basis. That fell to roughly 13 in September, just because the chip shortage was affecting production. It certainly was affecting, if you've been to a car lot, you know that there's not many cars for sale. And so you see that has played itself out, especially in that September, October timeframe. When you're looking at the retail sales data or the manufacturing production data, you saw some pretty significant declines. Fortunately, there was a rebound in October, and hopefully that rebound continues as we move into November, but that has played itself out in these data points pretty strongly. Now, the good news is that manufacturing production is, despite a very significant decline at the beginning part of last year, has largely bounced back, right? So we are about 1% or so above pre-pandemic levels in terms of manufacturing production and capacity utilization. So that's a nice positive, although it's not unanimity there. There's a lot of variance in that figure. So the next couple charts are going to show you all the major sectors in manufacturing, and I should say at the outset here, I should have said this sooner. You guys have these slides. You can feel free to distribute them as you want, so you don't feel like you have to take copious notes here, because there's a lot of data in the next couple slides as we go through these major sectors. But you can see, I noted in September, motor vehicle production fell 7.2%. It bounced back 11% in October. So that really led that 1.2% increase in manufacturing production for the month, right? So that was a large part of why that was positive. And you see some other pretty strong figures up here as well. And then at the bottom of the list here, you have some sectors that, at least in the month of October, didn't fare as well, like machinery and electrical equipment, et cetera. Now, those are all interesting, but I think from my standpoint, I think it's also important to look at what sectors have bounced back from the pandemic and which have not. And when you look at that, you see that motor vehicle, and I've mentioned them several times here, motor vehicle and parts actually was one of the few sectors that bounced back pretty strongly early on, right? And yet the chip shortage really that we've seen, especially since January, has pulled manufacturing production in that sector down, roughly 5 to 6%, right, year to date. And so, again, hopefully we can start moving past this chip shortage, especially as we move into 2022. But it's one of the more interesting sectors because, again, it was already at pre-pandemic levels prior to the current challenges that they're having. So the next three charts are a lot of data here. And again, I'm doing this largely just so you get an appreciation for just how different these various sectors are. And I'm going to basically lump the major sectors into three different buckets, right? So the first chart here is going to show you the top sectors that are growing the most, right, year to date. And you can see at the top of this list is aerospace and miscellaneous transportation equipment. That's largely because the aerospace sector is doing a little better. Airplanes are doing better. People are flying again. That's certainly a nice positive for the sector. And Boeing, which was having a number of challenges before the pandemic, has kind of bounced back and is doing well as well. So that's a large part of why that's towards the top of the list here. The number that's the color that stands out the most to me on this chart is the purple one, and that is computer and electronic products. You see a very strong increase in that figure, certainly from 2015 on, but certainly even during the pandemic. Notice that I'm virtual, I'm working from home. Everyone is focusing on technology and computers and the role that has to play in the economy. And so we've seen a very large increase in activity in that sector really over the last few years, but including during the pandemic, whereas others kind of fell and have bounced back. This next chart, not really a lot of storylines here, except to say these are the other sectors that have seen positive growth year to date. And so I'll kind of just leave it there. And then the last one here is one we've already most focused on. These are the sectors that year to date have actually declined. That includes motor vehicle and parts, but some other sectors have also been a little weaker this year as well. So anyway, that's a lot of information. I'll move on so as to not bore you with lots of data and charts. If you're looking for some positive news, which I tend to be a glass half full guy, there's two charts in here which I think show really a statement I made earlier, which is that companies are reinvesting in themselves, right? Both in terms of physical capital and human capital. So the human capital story that I'll show you a little bit later is the new job openings data. Again, we got newer data this morning. And this one speaks to capital spending in the US, right? So this is core capital goods. It's officially, if you're looking at the actual release, non-defense capital goods excluding aircraft. We call it core capital goods. It's a nice proxy for capital spending in the US. And you can see that we've hit record highs each of the last few months. And so we're not only above pre-pandemic levels, but we just keep hitting new records. So that again, to me, is a sign that at least when it comes to investing, we are reinvesting in ourselves, which is something you're seeing not just in manufacturing, but kind of broad-based. Okay. So mostly what I've described up to this point has been about the US. So when you're looking around the world, you see very similar trends, right? And so in addition to doing a Monday economic outlook, which comes out every Monday, right? And again, I post that on Twitter and LinkedIn as well as for our members. I also do a global manufacturing economic update, which happens to come out tomorrow, right? So it's always the second Thursday of the month. Also, I will post that on social media. And so this shows you the top 9 markets that we sell into. Number 10 is Belgium. It does not have a PMI, so that is why it is 9 instead of 10 on this chart. But you can see that there are 3 markets that were contracting just by a little bit in their manufacturing activity in the month of November. We get new data points at the beginning of each month. So much like ISM, we've been able to update this chart this week. And you can see that one of them is China, right? China continues to have supply chain issues. They've had some rolling energy blackouts. Workforce has been a challenge, especially throughout Asia because of COVID-19 and the Delta variant kind of pretty strong there. And so there's a lot of challenges that you're seeing, and we've been seeing some decelerating activity in China overall, especially for the smallest firms. Brazil is very similar, largely COVID related, as well as supply chain challenges in Brazil. And Mexico has really not seen expanding manufacturing activity, at least according to this chart, since the pandemic began. So it's been one of the few red charts up here for the entire time. Outside of that, though, you see that the global manufacturing economy is growing modestly. We've seen some easing in the last few months because of the supply chain and workforce and soaring cost issues, similar to what we've seen in the US, but overall still a nice growing figure. You're seeing stronger growth perhaps in North America and Europe than in Asia. But note that Omicron is hitting Europe hard right now, as well as Asia. So there are obviously some uncertainties as it relates to where we go from here. But the good news is overall the manufacturing sector globally is continuing to rebound, which is nice. Okay, now we go into the third of 4 survey questions. And this one simply relates to supply chain issues in general. And so for your firm, tell us what challenges are a major concern for you. Has your company been challenged by any of the following? And it looks like every one of you has picked at least one of these items, which is good. Just as a heads up, this is these 4 questions all come from the NAM Manufacturers Outlook Survey. So I'm somewhat stealing my own data questions. So when you see the next survey getting released, you'll see fully what our members said in the survey that just wrapped up. So we have another 10 seconds here. Looks like as of right now, the number one thing everyone's complaining about is workforce challenges, but you have higher input prices, logistical challenges pretty close behind that. So again, very similar to what we've been discussing to date, which is good. Okay, so let's go to the next chart. So this is showing you overall manufacturing employment. And so I noted earlier that while we've seen some weakness in the larger non-farm payrolls data, right, and in the month of November, manufacturing employment actually has been a bright spot, right? And so, yeah, we had a couple months there where we had declines, largely related to motor vehicles when they happened. Manufacturers in general have added 315,000 workers this year in 2021, and we still have 1 month to go. That's the strongest job growth, annual job growth since 1994. And so a very strong year overall, and a sign that manufacturing employment, while we're still not at pre-pandemic levels, has been bouncing back very strongly. So with that said, we still are. There was a couple in the BLS surveys that just came out. And so this is actually the graph to my Monday report that came out this last Monday. We added only 210,000 jobs in terms of non-farm payrolls in the month of November. That was a pretty weak report. And the consensus was probably closer to 500 or 600,000. Instead, we only got 210,000. But there actually, and most Americans don't know this, there actually are 2 surveys. One is the household survey and one is the establishment. The BLS uses both of them for different purposes in the jobs report. And the household survey actually had 1.1 million jobs being added in the month of November. And that probably is a little closer to truth. I mean, the reality is the labor market is very tight. We're seeing a lot of hiring going on right now. And so there's a lot of volatility in these data points. I suspect when we get a revision to the non-farm payrolls next month, that 210,000 will go up. The good news in that is that the unemployment rate fell to 4.2%. So that's the lowest we've seen since the pandemic began. Just a reminder that it was 3.5% in February of 2020. That was the lowest unemployment rate since 1969. And so we are very closely approaching what we economists call full employment, right? So that's a nice positive sign that overall the labor market is improving pretty steadily. And I see us getting closer to that 3.5 figure as we work our way through 2022. Now, one little caveat to that is that the labor force participation rate is nowhere near where it was pre-pandemic. So we did see a nice improvement in the month of November. It did tick up a couple tenths of a points in November, and so you are seeing people returning to the labor market a little bit. The good news is those people who came back largely got a job, right? So that's a nice positive. But you still have a large percentage of the population that have left the labor market. That includes people who have just retired and said, okay, I'm out. This is enough. This is too much for me. You've had a lot of largely women and minorities, especially those with less education, who have left the labor market, at least temporarily, largely because of childcare and schooling and health concerns. Many of them hopefully will come back in the labor market at some point. And manufacturers largely, almost every business that I talk to, have also complained about the impact that the unemployment insurance and other stimulus from the government has had in terms of labor force participation. I think hard data on that has been a little lacking, but we do continue to hear a lot about that, at least anecdotally, from a lot of our members. I do expect the labor force participation rate to continue to tick up a little bit over the next year, although I do not expect it to get back to pre-pandemic levels. I think some folks who left the labor market will simply stay out. And so that will certainly impact the tightness of the labor market and where we go moving forward. There was a couple charts in there that were in there twice, and so that was my mistake. The manufacturing employment, you can see here, we're about 250,000 below where we were pre-pandemic, but we certainly bounced back pretty nicely. So I'll go through a couple charts here, just like I did on production. This shows you the changes in manufacturing employment in the month of November, largely positive for the most part, although you did see machinery and motor vehicles have some weakness in terms of employment in the month of November. And when you're looking at relative employment today relative to where it was pre-pandemic, you can see that there are only 6 sectors that are doing better today than they were in February of 2020, and a number of sectors that are continuing to be pretty significantly challenged, although these gaps have narrowed over the last few months, which is nice and encouraging. Okay, so now we'll go into the last survey question, which is a preview of going into the job openings data. So here's your 4th poll. So while I do this, I'll kind of walk through, because I did bring it up on my screen earlier. We did the JOLTS data, the job openings and labor turnover survey data that were released at 10 o'clock this morning, showed 11 million Americans, 11 million job openings in the US. That would be an all-time high. And 1 million, a little over 1 million job openings in manufacturing, also an all-time high. So when we go through the next couple of charts here, you'll see that even though we're only a month behind in the data that I'm showing you, the job openings figures just continues to get larger, and a large part of why this continues to be such a big challenge. Okay, it looks like we have 5 seconds left here, and 91% of you have unfilled positions within your company for which you are struggling to find qualified applicants. So again, that's pretty consistent with what we are hearing from our members as well. So, and a large part of why that continues to be one of the top challenges. So again, this chart that I'm showing you is old now, and it looks like I'm gonna have to change the vertical axes to go over 1 million when I do the October one. So we had just shy of 900,000 job openings in the month of September. There's always a little bit of a lag in the JOLTS data. So that again is an all-time, the number that I'm going to give you is an all-time high. And you're seeing all-time highs in the larger economy as well. And the other component to that is, again, this is the September data. We had all-time high level of quits, not just for the larger non-farm business economy, but also for manufacturing. And this really speaks to the buzzword that everyone's talking about, which is the Great Resignation, right? Everyone is quitting and moving to other roles. For a large part, it was mentioned earlier in the description that I used to be the chief economist at the SBA, the Small Business Administration. I like to see churn, right? As that shows some vibrancy, some healthiness to the labor market. So we're seeing an enormous amount of churn right now. People are being poached, right? People are leaving a job, going to another job. And some of them might be leaving the labor market entirely, but for largely, we're seeing a record number of quits. And that certainly is exacerbating the challenge of finding workers. So we've had really for the last few months, more job openings in the US economy than we have people actively looking for work. And that's essentially where we were pre-pandemic for a couple of years, a phenomenon that quite frankly never existed at all in the data before 2018, but we've seen it now happen a couple times. But the other thing to note here on this chart is you see that the gap is obviously wider today than it was even before the pandemic. Now, I'm putting this up here. I suspect it's an advertisement for Burning Glass, but I do follow because the JOLTS data have a bit of a lag to it. So we just did get October. The data that's on these charts was September. I do look at burning glass data, which kind of combines all the job openings around the country, and that gives me a little more granular level of understanding of where the job openings are, what sectors, what skills are required, et cetera. If I'm traveling to, let's say, Cleveland or someplace else, I could say, these are the job openings that are in Cleveland, how many there are, what skills, who's hiring, all that kind of stuff. And so this is simply showing you a 4-week moving average of those data. You can see here they actually peaked out in May and remain elevated, but have pulled back a little bit. We're not seeing that in the JOLTS data itself. So these data are not perfectly reconcilable, but it does give us a nice window into what's happening on the job side. The other number of note here, in addition to the quits that I mentioned earlier, is that we had 5.4% growth, year-over-year growth in wages for production workers in manufacturing in the most recent jobs data. That's the highest since 1982. And it speaks to just how tight the labor market is. And the interesting thing is you're seeing even faster growth in some sectors like retail and leisure and hospitality and other places, which are actually double-digit year-over-year gains. And yet we still see the labor force participation rate not really budge that much, a little bit, but not a lot. Okay, so we're going to go through prices and outlook, and then we'll get to your questions. So the next couple charts are going to show you some of the soaring prices and costs that manufacturers are facing. And I'll start with this one, which is the PCE deflator. This is personal spending, is the fancy word. Personal consumption expenditures is a fancy word for personal spending. So this is the price index for personal spending. And you can see the reason why we use this particular chart and it gets so much attention is this is the Federal Reserve's preferred measure of inflation. Its target for core inflation, which is the red line, is for 2% inflation over the long term. And you can see that in October, we had the PCE deflator rising, a little over 5% on a year-over-year basis. Core inflation was running around 4.2, I think, percent. So essentially double what the Fed's goal is. So just put that out there. I will give my forecast here, which is I do expect the core PCE deflator to start to stabilize a little bit as you move into 2022. Supply chain issues will hopefully start to abate a little bit as you move into the middle of next year. You'll see a better base year comparison, right, as you're looking at year-over-year numbers and comparing 2022 to 2021. And so that will all help. And so my forecast for the end of 2022 would be for the core PCE deflator to be at least 2.5%, potentially as large as 3%. So you will see this number pull back a little bit from these kind of stratospheric levels, although still inflation is going to remain a little hotter than we might, and certainly the Fed would prefer. So that's the PCE deflator. The other number that, of course, everyone looks at is, at least from a manufacturing standpoint, is the producer price index. And so this shows you the monthly changes in the producer price index. This is the index for raw materials and inputs. The 1.2% gain in January of this year was the largest monthly increase ever in the history of this series, which actually only dates back to right before the Great Recession, but still a pretty impressive number. And we've seen some pretty solid numbers since then. Notice they've eased a little bit, but still some pretty healthy monthly increases over that time period. And the result is this chart. So you have the producer price index going up, roughly 8.8% each of the last 2 months on an annual, year-over-year basis. And a core the producer price index is roughly 6.4. You could argue that number has plateaued and it will probably start coming down in the coming months, but still those are very, very elevated figures. I'm not giving you the consumer price index, but it looks very similar to this one. And that number, as you saw in the press, was the largest since the early 1990s. Okay. So now we'll get into GDP. So we had just 2.1% growth in the US economy in the third quarter. That was a very disappointing reading, largely because the forecast, kind of coming into the third quarter was for at least 5% growth. And what really drug that figure down was largely the Delta variant and the fact people were getting out and about, and suddenly that was curtailed a bit. certainly for restaurants and bars and that kind of stuff. So the Delta variant certainly had an impact. The other larger impact came in the form of motor vehicle sales, as I mentioned earlier. Certainly that was a huge drag on GDP growth in the third quarter. And housing was also a drag on growth in the third quarter, largely related to affordability issues, right? You're seeing the highest record highs for home prices right now, largely because of building materials are much more expensive, worker shortages, and inventory continues to be pretty limited. And so that has been a bit of a drag. The good news is the fourth quarter should bounce back. I have a 6% figure up here. I've seen numbers as high as 8 being bantied out there for the fourth quarter. I'm sticking right now to 6. We'll see where that number goes with some more data as we get it in. So a nice healthy rebound, not just for consumer spending, but hopefully for business spending and for housing. We're seeing a little bit better data on housing. So that will give you a nice stronger reading. The downside here is what would happen from Omicron. I think if there's a risk to Omicron, it's probably more in the first quarter of next year. Certainly, the other kind of comment to make here about moving forward on the forecast is the impact that the infrastructure bill would have likely on growth moving into next year. Overall, we're going to grow around 5.6% this year. That's an annual figure, and 4.3% next year. I'm going to skip that for a second. And for overall manufacturing production, very similar numbers, 6.5 this year, and 4-ish next year. So I've talked a lot there. So I'll once again put my contact information up on the screen a second. I'll take that off in a second and stop sharing my screen. But this, I guess, is a time for me to allow questions for you. So Matt, I don't know if you were going to moderate the questions or you want me to just go straight into them. But I can look in the Q&A box here if you have questions that you would like to be addressed.
Yeah, Chad, it looks like we have one in here, which is, what are you seeing in wage inflation?
Yeah, I think that's one of the bigger risks that's out there, right? So I'm talking about inflationary risks moving forward. We're still seeing, as I showed in the charts a second ago, very stratospheric levels of price growth right now. And that's not going to abate fully for a while. I think certainly as you move into 2022, the supply chains hopefully will start abating or kind of lessening some of those challenges by the second and third quarters of 2022. So that will help. The base year comparison will also help, right? So this is the base bottlenecks and baseline effects that Jay Powell talks about. So all of that will be a positive to inflation moving forward. I think the bigger risk that's out there is this question, which is wage inflation. When I talk to manufacturers, every one of them tells me that they've had to raise wages very substantially this year to get talent. Some of them have had to put in signing bonuses to get talent. Not every company does that because they don't think it's fair to their existing workforce to do that. But many of them have had to raise wages very substantially in 2021 to get workers, and they expect to do the same in 2022. And I think you're seeing that play itself out, not just in manufacturing, but a lot of other sectors as well. The fact that the job openings numbers are a record high, right? And the fact that the labor force participation rate still remains much lower than pre-pandemic conditions suggests you're going to continue to see a very rapid wage growth moving into next year. I will give you a number that's on the fourth quarter survey. So I'm previewing a number, so hopefully don't run to the press with it. But we're seeing record wage growth expected in my survey for the next 12 months. Again, not totally a surprise. And you're seeing similar numbers, I think, in other surveys as well. And so, again, I expect that to be the bigger challenge moving into next year. And it's a large part of why, the Federal Reserve, I think, is going to act much more quickly than they were going to before, right? So they've already announced that they're going to start tapering their asset purchases over the coming months. Just a little bit of a background. They were buying 120 billion in assets every month, really since the pandemic began. Another form of quantitative easing, essentially, to kind of keep the economy propped up. There's really no reason for them to do that anymore. And so they were going to start curtailing that. So rather than buying 120, they were going to buy 105, and then next month 90, and then you get the idea. They're likely to announce at their meeting next week that they're going to step the decreases up, right? So they're going to increase the pace of their tapering, and where they probably were going to wrap up their tapering by summer of next year, I think now they'll have wrapped that up entirely by spring. And I think the Fed, where everyone was thinking they were going to start raising rates in the middle of 2022, I think that could be as soon as May. And so I think the Fed is going to react to the inflationary and wage pressures largely by starting to kind of normalize their balance sheet a little bit and start not only speeding up the tapering, but also raising rates as soon as I said, May. And I'm going to stop sharing my screen now. Everyone has my contact information. So now hopefully I can see everyone. So what other questions are out there?
Yeah, thanks for that, Chad. Yeah, we did get another question, and it's what are your 2 or 3 favorite charts of indicators you track in your analysis?
Well, I can't say the NA manufacturer's outlook survey. No. I think it's important to look at sentiment data in general, right? So whether not just the US, but globally, I look at the Purchasing Managers Index data a lot, right? So I would kind of lump a lot of sentiment data in that. The ISM, our survey, the Federal Reserve has a number of surveys that they put out, as well as the global surveys. And so I think it's important to see what perceptions are. So that's important. Number 2, just industrial production, right? We need to be able to see what's happening overall output in the US. And so that's a chart I look at. And the third, obviously, is employment. That is consistently towards the top of the list of challenges. And so seeing what's actually happening in terms of overall hiring, I think is an important indicator. I didn't say prices, but if I were to have a fourth one, probably prices right now would be high up on everyone's list.
Yeah, I think certainly price fluctuations and time to delivery, supply chain matters altogether, all very, very much top of mind for folks. In addition to that hiring we were talking about and resources.
So we have time, I think, for maybe one more question or so. Well, I guess I'll fill the vacuum here by saying that obviously I mentioned the infrastructure bill that will obviously have a nice positive to growth, not just in 2022, but moving forward. We've been underinvesting in infrastructure for a long time, so it was a nice win for manufacturers, nice win for the construction sector moving forward, and I think we'll start to see some positives coming out of that. And the nice thing is we didn't see a tax increase as part of that, right? It was that's a nice win-win, I think, for everyone in the economy. A lot of other issues. There's some challenges too. So, but that one was a nice positive.
Yeah, absolutely. It's far-reaching to your point on where that money is going to go and how that impacts industrials. Yeah. And to the tax legislative update, I know that's. Yeah. Maybe Chad, you gave us a little bit of plug there. That's why we've punted an extra week for that topic in our 2-day conference, so that we can not only continue to track what's going on in the Hill and what's regularly coming in and out of that legislative package.
Yeah, and obviously, the NAM does not support the Build Back Better agenda, largely because of the tax increases that are in there.
Well, while we filled that vacuum, it does look like we got another question here, Chad. So we'll field this last one, and then we'll give folks a chance for a bio break. So do you expect that interest rates will increase in the second half of 2022?
Yes. I think I would budget in at least 2 rate increases in 2022, maybe as many as 3. But for right now, I would say at least 2 rate hikes. Now, those are small. They're just 25 basis points. So whereas now the Fed funds rate is essentially 0 to 25 basis points. By the time we get to the end of next year, you'd add 50 basis points to that, right? So it's 50 to 75 basis points. So still historically low, but it's a movement back up in terms of rates. And quite frankly, I think the biggest worry that the Fed has is they're a little behind the curve, right? I think you're seeing financial markets are already starting to price that in, right? So the Fed is someone needs to react to where markets already are.
Great. Yeah, appreciate that. And we are going to go ahead, and with that, appreciate you, Chad, all the time, all the insight, and certainly as we're all navigating the current, the ability to use trends and predict what we believe 22 looks like, or get some insights from that. We really appreciate that.
Yeah, and if anyone is interested, they can always follow me on Twitter or LinkedIn, and they'll see what I write about JOLTS shortly.
Perfect. Yeah, and we certainly will continue to follow you.
Thanks.
And I know we had a couple questions, but if folks have additional questions, I know Chad put up his contact information. Mine is available as well. So we are here to address those and certainly to answer them as they come up. So we'll count that as conclusion of our first session.